emerge now into a new operating climate, they are looking not only at how they work internally, but also the way they interact with customers and serve their needs. Michelle Baxter, Financial Services Executive North America at Avanade, joins us today to talk about how they are helping customers and stepping up their expectations around sustainability. Thanks for joining us, Michelle.
Hi, Kim. Great to see you again.
What shape are we now finding banks in, and what are the positives that they are facing, but also what are the negatives?
So sure, there are a number of positives. Banks are in a reasonable shape. According to The Banker, the world's largest 1,000 banks have had the biggest annual increase in capital over the past 12 to 18 months since 2009. And I can think of three notable areas worth mention. The first is contactless payments. So there's been a significant increase in contactless payments, which we've probably seen in our everyday lives. MasterCard reported more than 40% growth of contactless during the pandemic. Visa saw more than 13 million customers in Latin America make their first online transaction in the first quarter of this year. And PayPal reported 20% year-over-year growth in payment volumes in April alone. So the second one I would mention is remote work. So some banks have moved swiftly to remote work. As of May 2020, Standard Chartered had most of its 84,000 employees working from home. They had to increase their capacity of their VPN by over almost 600% just to do that. And even traders who have always been tied to the office have shifted to remote work in very large numbers. One example would be TD Bank, which now has over 80% of its traders working from home. Finally, I'd mention loans, which in some cases have equated to net new customers, which has been a real win for banks. One bank alone, JPMC, as of June 2020, JP had issued $28 billion of paycheck protection loans to U.S. businesses, followed closely by Bank of America. So, there are negatives as well. Banks have underinvested in digital transformation, and those that were behind really, fell behind in their ability to optimize digital aspects of their processes. So customer experience operations, it was much harder for them to get going. A big part of this is that the banks are still shackled by legacy IT and a legacy IT mentality, right? So that, and then also the lack of data-driven sort of approach in a lot of cases has hindered. The businesses that are data-driven have done much better. Many are now seriously considering moving to the cloud, which is great news. Despite compliance and regulatory challenges, banks have been very slow, but now is the time. It's been certainly more appreciated. We're seeing several announcements on big cloud partnerships because the banks have fundamentally recognized the need to be more agile.
As you say, then it's becoming more and more important that the banks are offering that kind of services to their customers. So how could banks better help customers that may be struggling at this time? And could they make services that were more tailored to help them with their specific needs?
Absolutely. Interesting dynamic here. The opportunity is really around trust. So banks have been making money from customers for far too long by exploiting bad decisions, right? So when customers are overdrawn, they're charged a fee. These fees make a significant amount of banks' revenues. And many customers struggle to manage their money, especially now. So it's fascinating. Accenture found that only 14% of individuals would go to a bank if they were in financial trouble. Yet that should be the first place that they go for advice. So this points to a significant trust deficit. Accenture estimates that if banks can get this right, it's worth 5% of their total income to get this right. So trust-based offers, such as helping customers manage their daily spending or take advantage of life planning advice, can generate an average of 9% revenue uplift. And that, more than compensates for potentially 5% or so of revenues at risk. Personalization platforms, Kim, such as Flybits or Personetics, claim that more than 2/3 of customers are willing to share more data with the bank if their advice is personalized. So we're seeing contextual communications double, cross and upsell rates, improved customer sat by up to 35%, and reduced customer churn by 10 to 30%. And even if these figures are inflated, it certainly shows the potential for the investment. One example, one North American bank increased mortgage renewals by a factor of 3 over a 2-year period using this personalization approach. I also mentioned for commercial banking customers, relationship managers can use a predominantly virtual model. They have the opportunity to offer detailed sector-specific analysis on how to survive the crisis and the subsequent recession. There may be an opportunity to offer cash flow modelings in the transaction detail if the transaction details are available.
And how important is sustainability to banks and their customers? Is more transparency needed from the banks to win customer trust?
So it's interesting. Morgan Stanley research found that 84% of customers want to select products that are more closely aligned with their personal sustainability interests, such as climate change, community development, or companies that foster gender diversity. However, the share of this type of green investing is small. In 2018, 182 billion in green bonds were issued. That pales in comparison to the wider $6 trillion bond issuance market. So this is still pretty small in its nascency. The move towards greater transparency is gaining momentum. Walmart is working with HSBC to provide preferential pricing to suppliers that meet sustainability standards. BBVA awarded a sustainability-linked loan of over 5 billion euros, which was used to finance projects with energy efficiency and renewables. And why is this important? It's because millennials, who make up in the US over 25% of the population, they are poised to invest significant amounts of wealth, and they are very, very focused on sustainable investing. The interest jumped from one statistic I'll share from 71% in 2015 to 85% in 2019. And in millennial investors, from 84% to 95%. So 95% of millennial investors are focused on investing with sustainability in mind.
That's great. Thank you so much, Michelle.